of investor you are. So just a show of hands or a thumbs up, give me a reaction. If you are a safe investor, just give me a thumbs up now. So if you like to protect your capital, all right, Chloe, thank you. Okay, so we got the risky investors here with us. So those that like to take more risks, can you give me a little reaction? Madluba, sorry if I'm mispronouncing your name. Apologies. All right, Tozi, great. I'm in between, so I like more reward. So that's what I want you to think about at first, the type of investor you are. If you look at the scale that I'm showing you here, it's the risk tolerance scale. So you are going to be either more inclined, more to the one side or more to the other side. But you can find yourself in between this risk tolerance scale at different times of your life. All right, so if you go for more risk, your intention is to get more reward. You are risking more of your capital, and there's a higher chance of you actually losing your money. Whereas on the safe side, if you risk adverse, you are there, your main objective is to protect your capital. You don't want to take that risk, especially if you're nearing retirement and putting 80% of your money, let's say, in a high growth stock like Tesla. Because if there's a turn in the market, then you could find yourself in serious trouble. So depending on a few circumstances, like your investment goals, the experience that you have, your financial resources that are available to you, the time you have for your investment to mature, and also your fear factor. So depending on how old you are, how close you are to retirement, that will influence your decision of where you're going to move your money or allocate capital. So I have a little graph here on the left. If you can see it, you'll see if you're more risk adverse, the chances are that you're going to get an average return or below average return. And the higher you move up that risk scale, your return increases with that risk that you are seeking. Now, it's all not sunshine and roses. If you increase in your risk, the chances of capital loss, realizing capital loss, is extremely high. So you need to understand what type of investor you are before you even start. All right, and we will get into what type of investor you are and how you set goals. So think about that now. What type of person are you? Are you a risk taker or are you a safe, risk adverse? Once you understand the type of investor you are, then you have a few choices open to you. We call them asset classes. So you can diversify and obviously invest in multiple asset classes, or you can actually concentrate your risk of which asset class you are going to focus on. Again, that depends on who you are. Are you a risk seeker or are you playing in the safety zone? So some asset classes that are low risk include cash and bonds, which most people are familiar with, and they offer very low returns, usually even below inflation, especially now that South Africa's cut interest rates. We are experiencing negative real returns because our inflation is higher than what we are actually getting at the bank. But it's also important to keep cash because you need that for emergencies or to take advantages of down cycles, sell-offs in the market. So I'm not saying throw out your cash. You always need some cash on hand. So cash and bonds are IOUs. If a company wants to raise capital, you will give them your money. They will agree upon a set interest rate that you will receive. At maturity, you get your money back, and in that time, you've received interest. So those are usually the low risk assets that you can get involved in. And the closer you approach to retirement, these are the asset classes you are most likely going to put your money into, or a higher percentage of your money. Then we move into medium risk asset classes, such as property and commodities. So we're all familiar with properties. You have your residential property or property investment. We're speaking from a property investment perspective now, that it can be high risk if the economy is taking a turn for the worst. So these asset classes can find themselves in higher risk spectrums or lower risk spectrums. It also depends on the economy that you're investing in. Commodities like oil, gold, wheat, sugar, silver, the things that we use on day-to-day basis, that is commodities. So they are medium to high risks too. The higher risk options, just move this, are shares and cryptocurrencies. So most of us are probably familiar with shares, equities, stocks. There's numerous names for them. You're basically buying ownership within a company, so you become part owner. And cryptocurrency, which is the newest asset class on the block, which is extremely high risk. So if you are risk intolerant, or you like to take risk, like Tozi or Ricardo or myself, then you're probably going to dip your toes in the water there and allocate a small percentage of your overall capital, maybe 5 to 10%. That depends on the type of investor you are. So we looked at cash, bonds, property, commodity, shares, and cryptocurrency. We won't have enough time to explore them all, but we will look at shares, property, and commodities. So we've looked at what type of investor you are and the asset classes you can invest in. So I know I'm somewhere in between a risk taker and a safe player. Now I need to establish a goal. What's the reason I'm investing? Of course, I want to make money, but I need to be more specific. I need to define my goal. So I would recommend your initial goal being to build up capital as an emergency fund. 3 to 6 months of cash is ideal, but I keep 1 year's worth of expenses, because when COVID hit, it showed us that our lives can be turned upside down in an instant. So we need that buffer to fall back on, or to give ourselves some leeway to take more risk. Like if I'm unhappy in my job, but I know I can pay myself a salary for a year, then yeah, I'm going to switch jobs and maybe take that risk, and hopefully something comes of that. So I think your first stage is to build that and then look to take on risk or to build capital. So I've used the financial goal as building up capital for a deposit on my house. I get my emergency fund, that's sorted. My first initial step is to save 100,000. I work, I earn, I spend less than what I earn. I move to my next stage, is building 150. In that process, I'm looking to increase my income while I'm still spending less than what I earn, until I get to the end goal, which is to have that 150,000 in cash ready to put down on the deposit on my house. So that's a simple example as a goal. And then I go to the risk management model, where I identify what I want to invest in, or the market. I analyze the market or the investment. So I haven't invested yet. I'm just doing my research. Once I'm confident and I've got my goal, I understand what type of investor I am, and I've designed a strategy, then I take action. I don't go onto Twitter or Facebook and see, oh, they're talking about this share, I'm straight in. All right. Set a plan, set a strategy, stick to it. And once you take action, I am a buyer and a holder, but that doesn't mean forget about it. You have to reevaluate your portfolio as time goes by. Has the economy changed? Has the fundamentals in the company changed? And then you monitor your investments. And don't be scared to change your direction if need be. That's your control part. So before we get into the interesting stuff, just some tips to manage risk. Have a strategy, the most important. Before you buy that first share or you buy that first cryptocurrency or you have a long-term property goal, whatever your financial goal is, have a strategy. My strategy is to invest 20,000. I'm going to do dollar cost averaging over 6-month period. I'm going to buy in 2-month intervals with an X amount of money each time. That's my strategy. So regardless of what the market's doing or what I'm hearing, I'm sticking to my strategy. I know the type of investor I am. I know my end goal, and I'm following that path that I've set for myself. That allows me to All right, guys. Thanks for joining, guys. If you can just mute yourself for me as you join the call, that would be great. Thank you for joining me if you've just come in now. If you have any questions, just raise your hand for me, please. So that allows me to control my emotions if I have a strategy. Another way, if I'm managing risk, is to diversify. Diversify across countries, across asset classes, and currencies. So although I'm an extreme, I like to take risks, I don't want to take too much risk and keep everything, example, in one economy, one asset class, one currency. Diversify that, but you can still take risks along the way. Mixture of offshore and local. Some people recommend that you go completely offshore. If you are in South Africa, I wouldn't recommend that because I'll show you now how we go through cycles. And because your costs are in rands, you want investments that rise in tandem with your costs. You can also invest in value and growth stocks, which we'll get into now. I'll explain the difference. And constantly research. So you've got your goal. You know what type of investor you are. Now you need to decide if you are going to be a trader or an investor. So just some key differences here. A trader is buying and selling, looking to make quick gains. They're making short-term trades, a day, an hour, a week, months. I think SARS considers a South African trader if you're buying and selling shares within a 3-year period. So if you're buying a share now and selling it next year, you're a short-term trader. You're looking for quick gains and you are following technical analysis. On the other hand, if you're an investor, you're buying and holding for the long term. You're aligning your investments with your goals and you're looking to build wealth over that long term. And you focus on fundamentals of the companies. Now, I'm not saying you have to be one or the other. You can be a combination of both. But again, that comes down to your financial goals and your strategy that you have in place. So for me, for example, I know Sibanye is a long-term play. I'm not going to trade it. I might see I'm up 5,000. I'm getting excited. I'm getting itchy. I want to bank that money, but I don't. I have my exit price. I have my date. I have my strategy. So trader or an investor,